Good morning, everyone. This is Chihiro with Beyond Stocks, and I've got Mr. John Bullman. He's our fantastic guest today. So, really excited to get into that conversation. So, here at Beyond Stocks, we are leading a community of people who are interested in diversifying away from Wall Street, stocks, bonds, and mutual funds, and want to learn about how to invest into alternative assets. And so, John is a amazing guest and a wealth of resource, wealth of experience and knowledge on this topic. So I'm really excited to get into it. Real quickly, let's thank our generous sponsor. This episode is sponsored by Porter and Company CPAs. And listen, when it comes to accounting, you got to think of them like a doctor. If you have a broken bone, you're not going to go to a neurologist, right? So same thing with accounting. You want somebody who specializes in partnership accounting. So whether you're investing passively or you're running a deal as a general partner, you want an accountant who specializes in private offerings and is an experienced investor in private offerings. So for that, for my personal and business taxes, I go to Vince Porter at Porter and Company CPAs. Please visit his website, mytexascpa.com. Now, with that, John Bullman, welcome to the show.
Hey, good morning, and thanks for having me.
Yeah, thank you so much. So, we were talking before we started rolling here. You have a very broad and deep experience in alternatives and managing investments in general. So, I want to start with your journey. How did you get into investing, and how did you get into alternatives?
Long time ago, studied finance at Baylor. Uh, a professor got me into the CFA program, and if you give a mouse a cookie, I was able to get through that. Got hired on at a consulting shop at RBC, and we were working on pensions, endowments, some K plans or defined benefit, and also defined contribution. From there, recruited over to a family office back in '07. And that was one here in town in Dallas named Rosewood. Eventually led that investment team, and our alts exposure was just huge across the firm. Well more than half. And so that's where I really got my training, getting to work with some of the best, some of the biggest names, on the block, and got comfortable there. And a couple of years ago, then I landed here at LGT. And what's really exciting is all the firms we're used to, you'd have to write a $10 million check to get into the fund. The world of semi-liquid alts has come to the retail investor. They call it the democratization of alts. So now you can still invest with, say, Blackstone, KKR, Apollo, Stepstone, you name it, but in a product wrapper that has a 1099, so no K1, and you're getting exposure to that same team with that same great track record with those years of success. Only the minimum is something like $25,000. So that's what I'm bringing to the table, is really a family office style investing with that real diversification, a lot of alts, but for mere millionaires at this stage of the game.
Got it. So at your firm LGT, how is it that you achieve that democratizing and lowering that bar?
So, well, the products themselves have done it. So we can thank our asset managers for bringing those to us. And then there are a handful of platforms. We tend to use Case, where you can access these alternatives. And some are even ticker traded like a mutual fund. It really just depends. So it's my job, since a lot of these products are very new, to underwrite those, to do the diligence, to not just have the top down view of how I want to invest. That, okay, once that's sorted out, you have to decide who. And ultimately, you're investing with people, and you want to find best of breed. I tend to go, I go IBM, go with the bigger, the more successful, because every manager is going to hit a rough spot. But what you need is that firm to be there. They need to have that staying power, that access to the capital markets, and that team to support you even when things aren't going your way. Yet, do I do some of the nichier things? Yes, but that's really only for the larger clients who can, once they've gotten all their bases covered, can afford to do some of those more satellite style investments.
Got it. Now, one thing I want our audience to understand here is a lot of financial advisory firms, dare I say, are more like marketing or sales organizations. But what caught my attention that you said is you run due diligence on these investments before you bring them to your clients. So talk to us about that type of advisor who's doing diligence and analysis before presenting something to their clients versus maybe some of your competitors who don't do that.
Well, this is my first RIA, so I can't really speak to how my competition does things, but I'd say the philosophy is entirely flipped. You were hiring me to build you a great portfolio. I'm the one responsible, call it, I'm the mechanic picking the pieces that will, the pieces are just the investments that build the portfolio that take you, where you need to go, that help you achieve your goals. Any of those pieces, I might fire them as soon as I find someone better, or if the current one is doing something that I don't like. So I never lead with, "Hey, I am bringing you access to deal A or B or manager A or B." I'm saying you're hiring me to be on top of that and build you that durable, well diversified portfolio with a lot of different drivers of your risks and returns, so that it's the same old thing that you can get diversified and achieve your return objectives with lower risk than you would if you just owned a handful of things.
Got it. Now, with the seemingly th- there's thousands of options with alts, right? So, can you walk us through your process, like how you start at the top of the funnel with dozens or hundreds of options, and then narrow that down? So, what are some of the criteria that you're looking for as you drill down?
Well, it's actually worse than that. You don't get to start even looking for managers. You have to decide that what do you believe in? What do you want to own? The market, in my opinion, is always giving you something, it's always taking something away. So you want to invest step one in a area of the market that has an asymmetric in your mind risk and return payoff. So, and you know how I said earlier that you can get paid more on the front end of the curve before we started. Okay, well, the way the yield curve is shaped, you get a lot for lending short. Okay, floating rate loans in traditional sense pay about 7.5. Direct lending, other private credit strategies can be in that 9, 10, 11, or 12% range. That's a lot of income. If you think about your long-term rate of return expectation on stocks is maybe 8, but that's in equity. So if you can get, call it 10 senior secured, you have a very asymmetric risk profile. From there, I prefer to hunt. Okay, here's my view. I like short-term private credit lending. We'll call that direct lending. Okay, then at that point, you're looking at these products. Okay, who has the reputation? Who has the best fees? Who has stability in their team? So then from there, you can go ahead and say, all right, this is a best of breed manager. But what makes it really tricky is a lot of these newer products, they may have been around a year or two. There's not a lot of data to go off of. That's when I think a little experience helps, some relationships help, and you get them on the phone. You understand their team, their process. You form expectations of what markets will suit them and which markets will be more challenging. And then in my mind, that's everything, because when you have framed your expectations, you know when to dig in, you know when something stands out, you know when things are going according to plan. At that point, you can invest some money, and then hopefully you're right about all of those things, not just the market you're investing in, but you've picked a firm who is well suited for what you expect to happen.
Got it. Thank you. Now, you had mentioned your typical client has about 50% exposure in their portfolio to alts. So, um, maybe take us through the portfolio construction of like your prototypical client. Like, what's that portfolio look like?
So they're really two, and I'll call them lineups or models, but we'll talk about the growthier one because that's a little more fun. Um, well, you can only sum to 100%, right? So where am I overweight? Where am I underweight? I'm absolutely overweight in the private credit and also in the private equity spaces. So we talked about some of the reasons for private credit. In private equity, a lot of these funds, they're buying what we call secondaries, right? So pieces of or LP interests that trade on that secondary market. There's really two important dynamics going on today. The first is that the market is liquidity starved. So if you can be a supplier of liquidity where it's needed, there's a premium to be had. The reason it's liquidity starved is GPs have had trouble making distributions. In other words, transacting, selling companies. A lot of that has to do with they bought these companies when rates were much cheaper. The
Yep.
cost of capital is now much higher, which simply lowers the price. That's that discount rate everybody would talk about. So they're holding on to it for two reasons. One, to grow it more, which is their job, right? And then part of it might be the hope that financing costs come down next year or the year after, something like that, and they can really get that benefit of the more advantageous financing. But in the interim, Anyone who needs to sell the private equity interests has to basically take a discount. So there's two drivers of return then, the discount, but also the quality is there. People are having to sell things that they would rather own just because they haven't been getting the distributions they expected.
Now, one question I've had when it comes to private credit specifically is you're now one step or an additional step removed from the thing that is generating the cash, right? So, meaning if I invest with a private credit opportunity, then I'm investing with a firm that's lending my money and other people's money to another company. Do you have access to what their book of business is like, who they're lending to, and do you have the ability to underwrite those borrowers to be confident in your potential investment in a private credit fund?
So I suppose you probably have people on this podcast who do have that expertise. Mine is underwriting the manager, the process, and we will talk about their holdings. But what I am doing is I'm expecting them to be an expert in this case at making loans to those private companies. I know that I am not, but what I think I'm pretty decent at is finding the managers who are. And so every asset class will have its own nuances, its own pitfalls. And take, for example, the large cap direct lending space. Well, there's a lot of overlap in their deals, and there's a lot of great firms that are very big. In my mind, if you're going to own, say, a Blackstone or a KKR or an Apollo or something like that, you should own one of them. If you own two, you have some name diversification, but not really a lot of diversification in terms of the portfolio or the expectations. What can you do? You could say go middle market, hire a direct lender who goes to smaller companies, right? You could put in a more opportunistic private credit manager who might be buying CLOs or other, private debt instruments. So you're always building that portfolio. Every manager you put inside has to bring something unique to the table that complements what you already own.
Got it. That makes a lot of sense. Okay. And then continuing with the portfolio construction discussion, what are some other considerations as you're putting that together for your client?
Well, once you assume that you have appropriateness, let's just say that they fit the bill. It's everything you would expect. The team. You want there to be real assets there. You don't want them to decide they'd rather retire. You want them to have skin in the game, and then track record. So team, track record, and then firm quality and size. You also care about reputation. Life is too short. I think I can say the word jerks in this podcast. You want to work with people that you can get along with. Generally speaking, there will be several just fantastic firms that do what you're looking for. I've been doing this 25 years at this point. All this great didn't come from nowhere, and so I have the luxury of having a lot of very strong contacts, people who I have a lot of faith in, just not only them as people, but also I know what they've done. So you balance all of those things, and then unlike an economist, I have to put my chips down, and then good, bad, or indifferent, it's on me. Keeps me alert anyway.
Yeah. All right. Now, I do want to touch on your history with the Rosewood Corporation. So, for those of you who are in the Dallas Fort Worth area, Rosewood is a very, very well known family office, and you were the director of investments there. So, um, and you have a significant history there. You weren't there just a couple years, right? So, what was that process like? What was their process like in terms of investments and evaluation that has made them into such a successful organization? Like, what's their like secret sauce, the philosophy that drives that organization, and how they invest?
That's a really good question. I really have to give credit to so Rosewood is the descendants of Carolyn Rose Hunt, and I have to say they are just on top of being great people. They can take risk. They've been, for example, in the oil and gas business for a long time, and so when you have a lot of capital, you have then that in also that wherewithal to take the risk. And being part of it, this might be self-serving, but I think they hired great people. So then when you put all that together, and you gave those investment professionals some time horizon in an environment where they could take risk, we were able to make them a lot of money. So you should know that there was my team, and we ran, think of it more like an endowment style portfolio, well diversified, best of breed managers, a heavy exposure to hedge funds, private equity funds, and then also your more traditional investments. They also had an oil and gas team, a real estate team, and a direct private equity team. And so part of the beauty was all of the investors got to interact with each other and, learn and compare ideas. And so you had just a whole room full of sharp people that brought their own unique expertise to bear.
Got it. And what was your specialty there? I know it was alts, but like, were there any particular asset classes that you were focused on?
Well, we made a lot of money in private equity, so I could say that might be the one I'm proudest of. And post the financial crisis, there was a lot of concern, like should we keep committing to these private equity funds? By the time we got to early 2010, so many fantastic managers were coming back to market. At the time, I was not running the shop. I had my boss was named Ken Mindell, and Ken and I sat down and we decided that we were going to go back and ask for the budget to make it happen. To the family's credit, they did. And when you're investing in those vintages, things were cheap and also money was cheap. So even though it felt very scary because we'd all just lost a ton of money, which was extraordinarily painful, the opportunity set was there. So to their credit, we got the budget, not as much as we had before. We started making commitments again. We also started doing more in the growth equity and venture space. And the timing there, looking back, it was, we had to hold our nose a little bit because, it was it felt very risky. But the results were just fantastic. It was a great time to put money to work.
Yeah, absolutely. If we're talking about the 2010, 2011 timeframe, really to think about that was a scary time, right? Foreclosure rates in the single family home space, the S&P was like down, gosh, what was it? Almost 30%, if I remember correctly, right, John?
Oh gosh, I think point to point, so peak to trough on the S&P, I believe was down 40%. And so everything was a bargain, right? At that time, things were so cheap, and we talked about that macro overlay. At that point, you could take risk almost anywhere, and you were going to be fine. Today, look, it's different. A lot of things are stretched in terms of valuation. So as we've touched on, the market's giving you something, taking it away. It's giving you income, but also say look at just equity multiples. You'd argue they're priced pretty fully. Look at spreads, say in high yield, again, very tight.
Yep.
So we're not poised to deliver those same kind of returns as we were back then. I feel like that might be a little too obvious to say, but it's tougher now.
Yeah. I see a recurring theme here in our discussion here, John, which is that your job is to really be not a chameleon, but like a very adaptive, right? Highly adaptive to what's going on. And so I see that depth of experience in the way that you speak.
Thanks.
Now, let's shift the conversation here a little bit to a new announcement from last week. The President Trump issued an executive order that is expected to allow 401ks now to invest into alts. Can you speak a little bit to that? What you think the impact of that might be for our everyday investors?
So in general, I'm all for it. I think more diversifying options within a 401k plan that still have a nice expected return only help people hit their retirement goals. So broad brush, I like it. But just one step below that, alts doesn't mean a lot. That could mean crypto. That could mean things that don't have very much liquidity, and there could be some opportunists who call it marginal strategies in some of these 401ks. So when you're talking, say, public stocks, it's very easy to make changes. In one day, you can have a new fund in there. When you start talking the liquidity restrictions in a lot of these alts, well, the diligence is that much more important. Managing your liquidity inside the plan is that much more important. And so I'd say it's almost like I want to say invention of fire. Can you use it for good? Yes. Right. Is it possible to get burned if it's done poorly? Absolutely. And I don't know that a lot of the traditional just 401k plan advisors, whomever is helping you pick those options, really has the background in alternatives to pick the right managers inside that plan. So TBD, early days. There'll be some cases where it's done poorly, and people are unhappy. But in general, anything that moves that allows you to build that better portfolio, I'd take. And if I could do it here at LGT's 401k, maybe I should ask. We'll see if we can do it.
Yeah, absolutely. One thing I wonder about with that is if somebody who is older makes a private equity investment and which is fundamentally illiquid, private equity is, and they start hitting RMDs, required minimum distributions. How is that going to work?
So I would hope you don't put a lot of drawdown funds inside your 401k plan. The semi-liquid alts, those interval and tender offer funds, I think those are the products that should live inside a 401k. But you still have to get the allocation right. For example, if that fund is locked up and you have to take your RMD, well, you are in trouble. The fund cannot give you the liquidity, but by law, you have to take money out. So then you'd get a penalty from the IRS. So that's the point where you have to get that sizing appropriate. And as it gets smaller, as they start pulling out more and more money, you likely have less alts inside that 401k plan or IRA if it's been rolled over.
Right, right, absolutely. Yeah, I know you are a a student or a follower of like macro trends. Like you're very well informed on macro. So let's talk a little bit about that. Can you give us briefly your take, and then maybe we'll drill down on some particular topics, but your up to the moment feel on the macro environment?
Well, that's a big and broad category, and I'll start with inflation. It's my view that we have the pressure to the high side on inflation. PPI came out this morning above expectations. CPI last week also above expectations, and then more when you think about the other forces at work, there are a handful. Think about what the dollar has lost in terms of value versus the euro and yen. What that means is that then all else, tariffs aside, all else equal, things are more expensive now in dollar terms. Say you're buying that VW, right? That new Golf or whatever it may be. Well, VW has to raise the price on that now because they're receiving dollars that are worth less in euro terms. So there's that. When you disrupt the labor market with the actions of ICE, no political view here, one or the other, but when you reduce the supply of labor, you raise the cost of the remaining labor. That's simple economics. That's inflationary. The big beautiful bill is inflationary, and then tariffs. In just for uh, level setting here, the tariff is typically paid by the importer. Sometimes they can get the exporter to eat some of the costs, so on and so forth, but ultimately it's the importing country that pays. We tend to import way more goods than we export just as a country. So that will raise prices, and I'm pretty sure that's factoring into some of that PPI print this morning. So if your expectations inflation, what does that mean for investing? What that means is the pressure on that yield curve is to the high side. So as of yesterday, it may have changed today, but the market was calling for 3 rate cuts. I guess I'll go public and say, I don't think we're going to get 3 rate cuts. It's very simple. The Fed has 2 jobs. It's called the dual mandate. The first is keep full employment, which is defined as 4 or 5%, somewhere there for unemployment, and then to keep inflation. Their current inflation target is 2. So the reality for the Fed is inflation is a problem, it's above target, and unemployment is not a problem. They don't want to lower rates because that would exacerbate both the inflation and the unemployment that they don't need to go lower. So in my mind, we have rates that are, and think of it like the 10-year bond, even if they cut rates, I don't think that's going to move down. So what that means for me is I don't like duration, not very much at all. I own a lot of floating rate, whether it be public or private, and also some high yield, although spreads have tightened substantially. So that really boosts our current income, but certainly makes us, that's a risk for us if those rate cuts that I'm not expecting, but the market is, if those occur.
Yeah. Phenomenal commentary. Yeah. Thank you for that, John. This conversation takes me back to last week where I read a great commentary on Noah Smith's Substack. And he was specifically talking about AI and whether that could be a bubble of some sort. And one thing that just really struck me was it's estimated that the top So your NVIDIA's, Microsoft, Amazon, et cetera, right, are spending about $100 billion a month in AI. And so that's a huge, huge consumption number that is driving all sorts of metrics around it. For example, private credit, right? A lot of AI firms, hyperscalers what are they doing? They're borrowing in order to build out. So that was a fascinating commentary. Shout out to Noah Smith. He's on Substack. But um, what I wonder about is, so take floating rate. Totally agree with everything you just said, like, and why you would allocate to that. But then uh, being an investor, I think about the risk of that. And what if it's lending out to, AI hyperscaler, and they're just getting in way beyond their skis? These are the things I wonder about.
It's a great point, and if you make a loan to a company that can't pay it back, you will lose money. So not to be too blunt about it, but more broadly to your earlier topic, anytime, would you say 100 billion a month? Anytime that kind of money is moving around, of course there are going to be things that don't work out, things that are people overpay for. So yes, there's absolutely risk. Is it the future? Do I use ChatGPT on a daily basis? Yes. Is it going to improve productivity? I'd also say yes. But there's another risk if you switch to the equity side and do public stocks. 40% of the S&P is in 9 stocks because 2 of them are Alphabet. There's huge AI exposure in what we believe to be this diversified index. It says S&P 500. Not really. There might be 100 names in that index that matter. A huge number are tech, a huge concentration are these big tech companies. So if you want me to flag a risk, absolutely. If AI stumbles, the S&P will lose value, and most people view that as the market.
Absolutely, yeah. I've been Pedro knows I've been harping on that for forever about how the S&P 500 is really 7 firms and then 493 like, micro caps kind of.
Well said.
Yeah, yeah, absolutely. Well, so what's your advice to somebody who is a high income earner? They own a business or they're doing well professionally, and they're curious about allocating to alts. All they've known is the S&P or the Dow or just stocks in general. So what's your advice to that person to really start understanding the entire world of investments that's available to them?
Well, I would say for that businessman who's very good at what he does, but perhaps not a student of the markets, I believe the best times would be almost the same way mine is. Find an advisor with a CIO that you believe in. Someone who can tell the story in a way that's understandable. Someone who also has the track record and the expertise and perhaps the credentials that say they know what they're doing. Um, I think it would be asking a lot for your average investor to understand the nuances of all these more esoteric asset classes. I believe that gentleman's time or woman's time is best spent growing their business as fast as they can, doing what they're good at, and leveraging, investors and advisors who have an expertise where they don't. The if they want in education, there are a host of podcasts, for example, like yours, where you can hear from just extraordinary people who are investing money every day, and they can get up to speed that way. But I don't know that it's required.
Got it. Got it. Great advice. Now, what does an ideal client look like for you, John?
Oh, well, I could, make a handful of jokes, but we have a ton of small businesses, and I love them as clients, right? So really, no matter what their current liquid net worth is, we want to make it where when and if they have that liquidity event, we know what we're going to do with the proceeds. We have their trusts, we have their accounts, we have their plan in place so that when they do enjoy the fruits of their success, there's no anxiety there, that they're well invested. Of course, if someone has a lot of liquidity today, and perhaps they want to generate a lot of income to support their lifestyle, or if they have philanthropic needs, remember, this is a bespoke process. The clients
Mhm.
come to us and we build accordingly. So provided they have goals that we can achieve, if, for example, somebody wants 30% returns and zero risk, I'm quite simply not your guy. But if we can meet their needs, we sit down, we have the conversation, and we build them one at a time.
Got it. Now, if somebody wants to learn more about you or about LGT, your firm, how can they find you guys?
Well, we're online, and so of course you can see the website. My LinkedIn is rather up to date, and so I would say A or B.
All right, got it. Well, any last parting words for our audience, John? You've been a wealth of knowledge here.
Well, thank you. Thanks for having me. And I would say if you're going to invest, make your plan and stick to it. Don't overreact.
All right. Well, John Bullman, you guys, amazing, uh, like just full of content, valuable information here. So thank you so much, John. And we will see you on the next episode. Thank you, everybody.
All right. Thank you.